Off the volume. Funny timing. Hello, my YouTube friends. Happy New Year. Merry Christmas. I hope everybody's doing well. Um, I'll fumble around a bit. I have some things I'm going to talk about a little bit that I prepared just in case. I know I haven't been doing the lives that often lately, so I figured I'd have some things just in case um, until people show up and get involved. And have a sip of my water. If anybody's got your own drinks, feel free to chime in. Let me know what you guys are having. Ryan Williams always talks about that, but we got nobody here yet. So take a sip, relax. I am going to probably talk about my top picks for 2026. Um, Give you guys an idea of what I like about them and what's going on. Um, I've talked about some of them, but I put down five of my top companies that I like going into next year. I am also watching Steve Leisman a little bit in the background, trying to get an idea of what's going on CNBC as well. Feel free if you guys have questions or as to anything you want me to look at and stocks you want me to do a breakdown, check the numbers, see what I think on them. I'm happy to do so. Um, but let's start with the five stocks that I really like going into 2026. I am not picking the ones like there's obviously going to be things that outperform it. There's always these outliers that are a little bit smaller market caps that are very hard to guess which ones are going to take off and really do well in the economy. Um, I actually am a little bit bearish on Home Depot, other than the fact that the stock has already fallen so much. And it looks like at this point their earnings are pretty reasonable. But I went in there a couple times and I couldn't, it was like a ghost town. It was weird how empty it was. Um, Made me concerned about how they're going to be doing going forward for this year. I think they've overbuilt and there's too many of them. And people like I see in comments when I'm watching some videos about it because when I saw how slow it was, I kind of went and searched a bit on Home Depot to see what people were saying. And in the comment section, there was tons of hate. Now, in a lot of videos, there's tons of hate in the comment section, which, when I've talked in other videos that it's one of the things I don't really love about the doom and gloomer videos. I think it helps to keep people in a position of not doing well in their lives. And I think that kind of sucks and it's the wrong direction to go. These woe is me, the real estate's going to collapse or the stock market's going to collapse or whatever else they talk about, which don't get me wrong, any of that can happen. So I'm not saying it can't happen. What I am saying is by constantly talking about it and getting people on their high horse that, housing has to collapse 50% because then it can be affordable. It just keeps people from actually saving and investing and putting themselves in a better position. And it kind of makes it okay. Like it's an excuse for them for life to be lousy and not get out of a position you're in. So it's kind of why I hate those doom and gloom videos. And I hate that people get so negative on it. I also think that they use it as clickbait to some degree. I've watched a couple of these guys who've been talking about an impending house collapse since just before COVID started. And in the back of my head, I'm thinking, man, you've watched house prices double in the meantime. Interest rates go from below 3% to up to, at the highs, they were in the mid sevens. They've come off since, but you've totally talked people out of taking a step to putting themselves in a better position and kept them in a bad position as they chime in the comment section about, oh, the world sucks, the government sucks, the economy sucks, there's no way to get out of it. And I just think that's a terrible way to be. My overall goal, if I reach to people, is essentially to my hope is that people put away and save and not worry so much. If things go down in value, they go down in value, and you continue to invest and put away, and hopefully it works out in the end when you get to the end. When I was, I grew up fortunate in the sense that my parents always talked about the stock market. I guess my dad passed when I was little. Not that that's not where we're going, but when she would talk about the market, the goal of the market was just to outperform putting the money into a bank account. It wasn't this, I'm going to double my money in a year or whatever thing it is that people hope for, making 20% return. But back then, I mean, this was when interest rates were high. You could put your money in a savings account and you might get 3 or 4% interest, as opposed to today that you have to be in a high yield savings or search something out. And the goal of investing in a stock, good morning, hope you're doing well. Um, the goal of putting in the stock market was just to do a little bit better. It wasn't what it's turned into to trading or anything else. Good morning, Lee and Quinn Hua. I'm guessing it's Lahua, who I kind of know. Anyway, so that was really always the goal of putting money into the market, and I hope that that's what I encourage people to do, which is just to kind of maybe outperform putting it in a savings account or a checking account, or doing things like that you don't really know what to do or how to invest or where to put money. So it's not this get rich quick. Ari Gutman always says, get rich by Tuesday or something. Um, it's not that I'm trying to encourage anybody to think that things are more than what they are. But going back to those doom and gloomers, I think they talk people out of putting their life in a better position. It justifies not investing. And from my end, I don't care what you invest in. You could buy Pokemon cards. I mean, there's collections and things that go up in value that you'd be amazed where you can find things. And I'd suggest sticking with the things that you know and what you think could do well. So let's see. First question from Nick Nelson, our first comment. There has been an increase of 25% on copper and steel prices, as well as similar or not higher costs of other construction materials. This will increase the cost of homes, schools, hospitals. In fact, yeah. And look, I read an article. Not only the cost of the goods going into building things, which is going to drive the prices higher, in my opinion. Um, and as always, this is not financial advice. At some point, I'll do my little disclaimer. But it's not just the cost of goods, but the cost of labor and everything else pushing the prices higher. And even inflation gives an opportunity to try to raise prices a little bit better and make margins better as well. But absolutely, copper, silver, everything else. And then what I started to say is a friend of mine shared an article about the Trump administration taking a policy of a weaker dollar, which doesn't surprise me. The interesting thing to me about weaker dollars, I used to trade currencies, and it can really start to get your head to spin trying to figure out how that's going to impact things. The general basis is, think of, if your dollar is weaker, you need more of them to buy the goods out there, which is sort of inflationary. But at the same time, we have a Fed that's coming in that's more than likely going to cut rates. Like, he doesn't control that, so you can't guarantee it. But let's add those two together. So you have a Fed who's probably cutting rates, as well as a weaker dollar policy at the same time, meaning if my dollar is no longer as strong as it was before, it takes more of those dollars to buy things, making it seem like you might see the long end of a bond curve start going higher if the dollar is getting weaker on that level. However, I do think that the economy will kind of slow. I think this is balancing things out a bit. The weaker dollar makes assets go up in value. It will also make earnings do better because they'll have to get better margins on things. But if people are already stretched and incomes aren't going up, you're not going to see a wave of more volume of purchases. You will just see prices higher and assets more valuable and things of that nature, balancing into what I think Trump would like. I mean, that's just my guess. And it unfortunately does help the wealthy more than those who aren't, because if asset values are going up and salaries are not, those who have assets are going to do well. So higher copper prices won't affect new home prices here in Florida. Most builders will be lucky if they sell out. Yeah, well, demand across the country has been slowing down for sure, Joe. I mean, but it has hit this level. Like, I don't think we're going to see a huge influx of a bunch of inventory. Like when we go back to 2008, there were a whole lot of things that contributed to that. And my personal opinion is that the loans that were in place were a major part of that. When you look at the option arm and the things that went into it, it if you watch The Big Short, like the guy in the beginning, my brother kind of had the same prediction. It was almost obvious what was going to come because you pumped out so many of those loans at such the same time frame that it was inevitable that the payments were going to go up when they seasoned. You were going to have a whole ton of those payments going up. And the problem is first of all, I don't think it was explained well to a lot of people. And even those who it was explained well to, I don't think they really pay attention or do what's advised to them. So most people, if they get a statement in the mail for their mortgage and they've got four different options, they're probably going to take the least expensive one, no matter what they've been told in advance. So let's see, did I read that Zero Hedge article I posted? I haven't seen it, no. Sellers in some parts of F1 are 100% more than the numbers of buyers. Yeah, I don't doubt that, but they're in a different position. That's kind of where I was going with it. So you go back and you add those option arms into the equation where somebody would get in the mail essentially a mortgage payment and would give them four different options, all with different prices they could pay. And I think most people, no matter how well their mortgage advisor, and I doubt it was explained well, I doubt that the loan officer really made sure their clients understood, but I'm guessing when they got that statement, something like 70 or 80% of the people were picking that lowest payment, which actually like it adds on to your mortgage balance. And the sales pitch, because I was going through trying to get my mortgage license back then, which was super simple. It was just getting a business card. But the guy who was teaching the class about what you do, I mean, he kept talking about, brother A and brother B, and if you just invest the money that's the difference in the payment and get 10% a year in your investment. And I'm sitting there going, well, where are you guaranteeing 10%? And he's like, well, housing always goes up. And I'm just like, no, housing doesn't. And my wife's getting all annoyed at me because she was doing it at the same time. She's kind of like, kicking me a bit under the table or pushing me, telling me to shut up and let the guy teach the class. But I like finance, and I'm not just going to blindly agree to what somebody's saying. And I was kind of trying to tell him the same thing I'm talking about to you guys, which is, and no matter how much you tell people that, if they get a statement in the mail and they have these four options ranging from anywhere on average, like these aren't exact numbers, but it was kind of what we were going over, like an $800 option up to 3,000. Because you had the negative amortized one, which means like you're actually adding on to your principal balance. You had interest only, the negative amortized one was the lowest payment. Then you have interest only, which is only making the interest payment. Then you have the equivalent options of a 30-year mortgage and a 15. So you're going from like adding principal balance to a 15-year payment. They're going to have a huge discrepancy. So can you explain Trump's claim that drug prices have been reduced by by reducing the, yeah, I'm not well educated on his math either with that stuff. Look, I like some of the policies he's passing. I am not political, so don't take that as my opinion on who I like, I don't like. I will admit, so if you guys care, that I am happier that he is in office than Joe Biden, but I also think he's says a lot of shit sometimes that is just so stupid and it's embarrassing, and it's like, I can't believe that guy just says that. And I think he just makes stuff up on the cuff to try to sell whatever he's selling. Like, I don't like the guy. I don't know, all of that with the politics. So either way, I just don't see that today. And yes, we have had a big increase of inventory, but when I look at the inventories in the real estate, it's pretty much where it was before COVID. I am not seeing this huge, massive influx. And kind of where I'm saying the difference is when you take people who are used to making $800 payments and that seasons to where they have to make their mortgage payment of a natural payment. And it goes from you have these four different options to all of a sudden you get this bill in the mail and now you have to make a traditional 30-year payment. So it's probably going from like 800 to 2,300-ish. And now you're caught off guard, even though this was explained to you when you bought the home. And now just, it doesn't have to have had to correct at this point, but if housing has not gone up in value and you've added on to the principal balance, all of a sudden you start owing a little bit more than the house is worth. And when that happened in droves, and not like now where we're having natural ebb and flow of a market, and we are going to see some foreclosure that is going to look like as a percentage, it's super high because during COVID, you were given forgiveness, interest rates were super low, we had pretty much minimal foreclosure. The percentages will look really high, but it really isn't that big a deal or anything out of the ordinary. That's kind of why I don't really see a market crash coming for the real estate. I do think it could continue to slow and we could see prices drop 5 or 10%, but I don't see any massive correction because I don't see where the huge influx of inventory is going to come anything more than what's typical. Then on top of that, if it really does start, they're already talking about lowering interest rates, right? So we're going to have interest rates cut. If the housing starts to topple, they're then going to really implement QE, not just what they've already initiated by buying some of the short end stuff. They'll go to the long end and they'll support the mortgage backed securities. And I'm guessing the Fed will buy mortgage backed securities to push the price higher and the interest rates down, hoping to catch the real estate if it begins to fall. And then if it really starts to topple, they're not going to want another 2008, and they'll do something like the CARES Act and allow forgiveness and people to not make their payments and then tack it on at the end. And I hate to simplify it. And I also think all of these things are not good. It's hard for me because when I talk about it, people hear it the wrong way, thinking that I'm saying like the real estate market's great, blah, blah. I think the natural ebb and flow of a market is a good thing. And coming in and stopping a crash from happening is really bad for future generations. Like if somebody gets overextended and loses a house, that actually creates opportunity for the younger generation and somebody to get in at a fair price. If the government stops that from happening because they don't want to see the economy collapse and these are all such terrible things, it does create the haves and the have-nots, where the people who already have a home just continue to get further and further ahead, and those who don't, it becomes tougher and tougher. So I think when you combine all this stuff, it is not great for people. But I do also just analyze it as I think that's kind of what's going on in the market. So I don't see a huge housing collapse. You may have certain areas like Florida that you mentioned, because Florida has Florida specific issues going on. Maybe they have a bigger pullback than other areas, but I still think as a whole, as a country, we're just not going to see a 2008 like that. Um, so let's see, I did miss a couple things. At least Trump telegraph. Yeah, right. So Joe's saying at least Trump telegraphs which sector of the economy he and Paulson will work on collapsing next. First, Trump took care of crypto. Now banks will collapse soon. Now, I don't know that I think they'll collapse, but I would agree that I like how straightforward he is, and if you just pay attention to what's going on, he really is telling you what may likely happen in the markets instead of like, I don't like that they all cheat. Like it seems pretty evident, but I'll joke about OKLO because anybody who's watched it, this is a company that loses money, that went from under $20 a share to I think 193, and still loses money. Like nothing has happened in the company that's any good. The only thing that I know that's happened in the company is Trump nominated the guy who was on the board along with Sam Altman. He didn't nominate Sam Altman, but he nominated the guy who was on the board to be director of energy. And the stock goes up tenfold. Like it's such a joke. And nothing has really changed in the company. And meanwhile, it's fallen off 50% from those highs. And the company could go to zero. But in the meantime, if you're watching what's going on, and same with Intel, they took an equity stake in Intel. And to me, it was a no-brainer. And the stock has doubled since then. And I hate to admit, I think it probably keeps going. And here's a company that was failing. I don't know what they'll do to get the earnings up because they were failing for a reason and really struggling and talking about selling off the parts. But yeah, they telegraph what's going on, and I think if you just pay attention and listen a bit, it creates some opportunity. The market will take care of the long end. Um, I think you're right. I was just saying if they need to. I think the economy will slow enough that the long end will probably slow with it. And I think that's kind of what's showing on right now. So, what are my picks for 2026? Okay, let me get into it. Um, let's see if I miss anything. Yes, I am clearly a Muslim. That is correct. Um, anyway, so I'm only going to go over the top five. I'll mention some other things that I see there too. And I think I might have mentioned these in another video, but possibly not. Um, Number one is United Health. I still think United Health um, is still undervalued. I think the correction we saw before, nothing has changed really in the company other than the overhang of the Department of Justice. I do think that there's not a whole lot of problems going on with it, and I think that's why we saw not just insiders but people who work for the government um, buying the shares up more than ever before. But the company fell from, I think, let me take a look before I misquote it. Um, but I think it was like 600 a share down to 240. Let's see, 52-week low and high. So yeah, 606 down to 234. And it's come from 234 all the way back to 330 currently. But it's still, in my opinion, it's trading at 17 times the past 12 months earnings. And I think that's really reasonable for a company that was growing at the pace that it was growing. And if and when they get past the Department of Justice's issue, I just don't see why they would be trading at such a low level versus how they were doing before. Um, I, I just see healthcare continuing to be what it is. Especially, I think the overhang of the nervousness of how the current administration may change things and earnings may be tightened up and things like that. So you got another 2 to 3 years of that going on with United Health. But they raise the dividend at a pretty rapid pace. It's almost a 3% yield. So I think if it's growing as quickly as it used to be, which there's no reason it shouldn't, I just see it as still even up almost $100 from the lows, a great opportunity. Number two that I have, and these are not really in order because two and three I could interchange for different reasons, but as Amazon, I don't feel like I'm really stepping out on any of these. I just think that they're really good companies that to me, like Amazon's kind of lagged in the way that Google was. Now, it doesn't have the overhang of a bunch of negative information, but when the earnings come out, it doesn't seem to pop the way it does. Everybody's overly concerned um, with their Amazon Web Services not growing at the pace that they want it to. But to be fair, it's partially because of how big a company it already is, and and David, don't worry, I'll get to Wells Fargo. I'll put it in the background so I don't forget to. Um, but I think part of it is that you know that Amazon, their web services in comparison to Google and Microsoft is so much bigger, it's harder to grow it at the same percentage rate as their competitors. Their competitors have such a smaller percentage of the market that it's easier for them to grow them. And quite honestly, they might be with both of them. Like when one of them has a shutdown, they might end up putting in accounts with all three places just in case somebody's having trouble one day and they don't want their company shutting down because something in the cloud falls and has an issue. Number three on my list is Meta. Meta is my largest holding, as a little disclaimer, or whatever you want to call it. I was fortunate enough to pick it up in 2022 when it collapsed. But when I look at the earnings and how they're doing and the pace that they're growing, they still seem undervalued to me. So going into next year, I really love Meta and where it's trading currently. They had good earnings last time. Similar to what happened when it crashed back in 2022. What the market didn't like about it is how much they're spending on capex, but Zuckerberg really tried to comfort them this time that this is optional. Like, A, we don't have to be spending that much. So it's very easy to pull back the reins if it becomes an issue. And B, the things that we're investing in are things that we need for ourselves anyway. So if it doesn't work in terms of growth and pushing the company and things that I think it's going to do in terms of AI, it's not like I'm just wasting the money on something we can't use no matter what happens. So I really liked what he had to say. I think the market is overreacting when they sold it off and it fell below 600. I think that was a great opportunity to get long. I did add on in a trading account, but it's very hard for me to because Meta is my largest position by more than double what number two is, just because it had such a great run from 2022. Like when that correction happened, I picked up Meta, Amazon, and Google, and Meta has went from under $100 to over 700, while the other ones just kind of did well. And don't get me wrong, they've done exceptionally well from those prices. They were all under 100, but neither Google or Amazon has gone up the way that Meta did. Um, the fourth one I have on my list, four and five were the two that were a little bit of outliers. That the pullback of recent on both of them is what I like. The number four that I have on there is Netflix, because I actually really like. I like the buying of Warner Brothers. I think that really helps Netflix. And I'm not too concerned about the debt they're taking on because the amount of revenue they have coming in will be more than enough to help cover it. And if they overpaid for it, I still think it fits what they need for their company. And I think in the long run, it's such a great purchase for them. A, by giving the studios, B, by now being more enmeshed into the movie theater side of things if they want to go that route. I'm hoping that they do and they don't just go straight from, developing things onto their platform. The other thing that I really like about Netflix is I think it's kind of recession proof. And if you like, tell me if you see it differently. I think if we go through a rough economy, I don't know that anybody really gets rid of their $8 a month subscription to Netflix. Like, I think it's cheap enough that nobody's changing it. I do think if they raise the price, it could impact it, but I see Netflix under $100, and I think that's a really good opportunity. I did buy some. I'm using options on it as well in case it goes lower, as well as if it goes higher. I did see a video that somebody started talking about, and I like. So let me switch to that real quick because I did want to talk about it. And then let me see if I missed anything here, and we'll get to Wells Fargo in a bit. Um, and I do agree with Joe. I worry that I'm going to look at Wells Fargo specifically, and it looks when I see it on here like their PE ratio is still pretty low. But when things get too much in the news, I feel like they're a little overvalued if it's everything's going great and vice versa. When the banks know, when everybody hated them, I kind of figured they were a little bit cheap, and now I feel like it's kind of gone the other way, but I'll delve into it a bit too. um, so he was talking about using like 1 year options, and what I like that he had to say is, a lot of people on YouTube are talking about wheel strategies and 1 month or weekly options or anything else. And I really liked when he said if you try to do monthly options, the odds of making 12 bets and winning all 12 of them is extremely low. I would agree with that. What I don't like along the same lines as some of them is because he was talking about how, not to use cash secured puts, but to use portfolio secured puts because if you're already bullish. So here's the problem with a lot of these guys that they seem to miss the boat or at least not explain well. They're just using leverage, and it works great in a market that's going up. It's wonderful to be long a stock as well as sell puts in it because you're bullish and see it go higher. And yes, you will outperform so long as the market continues to do that. But if there is a real correction, and I don't mean COVID, I mean a long-term sustained correction, which, forgive me, I don't really see it coming, but it could. And to totally neglect to discuss the negative side of the bet and just make it like, oh, it just increases your profits and this is such a great way. Because let's say I sell puts and we'll use the one, United Health, Amazon, and Meta. Even if the stock goes lower, I just want to buy more anyway. Well, that's true, other than when the rhetoric and the reason that the stock has gone lower creates a new problem that it may stay lower. I think he kind of, yes, if Meta continues to have better revenue and better earnings and everything else, and for some random reason the stock price drops, like they don't like the capital expenditures or something of that nature, and you are happy to pick up more shares, sure. But when it becomes a scenario like you're stuck in United Health and you thought it was a great company at $500-600 a share, and the CEO gets shot, and then they have some rough earnings, and the whole demeanor of what's going on in the company changes, and you've sold puts as well as being long because you don't keep cash on the sidelines and wanted to do a portfolio secured put, well, you might have a different thought on it. I think the puts in Meta that he had were the 480s, and I was hoping to have a good conversation back and forth. But I kind of said, if Meta's getting below 480, it might be not just be a blip, it might be that something is going on where they're struggling. So, anyway, number five, and then I'll look a little closer at Wells Fargo. I picked Oracle. I know the negative going on, I know they have a ton of debt on the books, but I also like how far they've pulled back. And the funny thing is, they're still up something like 15% on the year. And I think they're trying to transform to where they stay relative and continue to grow. And I like companies that do that. It's part of what I like about Facebook. When he did the metaverse and the other stuff, I think it's Mark Zuckerberg still trying to push. It would be very easy for him to just become a equivalent of Coca-Cola and sell advertisements and pay out a big dividend. But these guys are still pushing, and young. Well, Ellison's not quite young enough, but they're still pushing to be a big company. Um, yeah. So Joe just made a comment, and then again, Wells Fargo, I haven't forgotten you. There's absolutely no reason for the Fed to be buying short-term treasuries. The banks must be in big trouble behind the scenes. Now, let me see who asked about Wells Fargo. David, were you the one who wanted me to? So David, that is actually my concern with the banks too. It didn't make sense to me, but it is above my head. I'm not part of the Fed. I understood that there's no reason for them to hold rates higher. It was okay that they cut. I didn't think it was needed. But like Joe's comment, I saw no reason for them to start buying short-term treasuries to support the market, and don't understand why they would need to. And it concerns me that maybe something's going on behind the scenes where they feel the need to support the banks or whoever is stuck in a position that's a bad position. Because everything else, even in their talks and what they discuss afterwards, is the economy's doing okay. Unemployment is not where we would like it, but actually the unemployment level is low. We aren't seeing a huge spike, but people are stuck, like they're staying in their jobs longer. So, like, there's nothing negative. So, why are you cutting rates and changing the terminology of quantitative easing, but starting quantitative easing? Unless there's something going on that there's some trouble going on. So Joe's comment, to be fair, is actually a bit of a concern of mine as well. It might be conspiracy theory. Maybe everything's fine but why would you add on to your balance sheet if everything is going great? It just doesn't make sense. Which is also why I say, despite, like, I don't know if the market will naturally soften on the long end too, bringing mortgage rates down, or if the Fed will have to step in and do quantitative easing. But at least what I pick up on. Joe, feel free to comment if I'm wrong. Joe's kind of pretty gloom and doom with the markets, and some of the things he talks about, like I see as well. So it's interesting seeing how it plays out. As a trade, I think it's great that metals are going higher. As a question in the back of my head is what the hell's going on for them to move at the speed that they've moved? Because if the economy corrects, everything's going to be caught in it. Like everything will be. And again, like I don't want to be a gloom and doom guy because I want you guys to save and put away. And it really shouldn't matter. Hopefully, there's enough income coming in from work or whatever else. The investing is, something that you just continue to put away and save so it grows by the time you need it. Those of you like me that are getting older, you become a little more sensitive to, I hope there's not a huge correction as I'm getting to where I want to retire, but I'm also assuming there are a bunch of you guys out there that are pretty young. But why are they cutting rates and starting quantitative easing when everything's going along just fine, which is a definite concern for the banks. Now, Wells Fargo in particular, like the basics, their PE looks just fine. Let me open things up and see what it says when I get into the fundamentals. All right. Very little short interest, which is great. Small dividend, but they're only using 27% to be able to pay out, which I love. It's, I've talked about it in other videos. I love that with Target too, although they have a higher dividend. When they're only using a small percentage to pay out the dividend, it means there's a lot of room for things to slow down, a lot of room for mistakes or things like that. Debt to equity indicates a more aggressive using debt. So they've been using a decent amount of debt more than 85% of its peers. Earnings per share, dividend, effective valuation. So their PE ratio is a little bit higher than most of the banks, but they're a better bank, I would say. I mean, return on assets, return on equity, 12%. That's pretty good. Yeah, more efficient than 75% of its competitors. Operator Wells Fargo controls its costs. Yeah, I think they're fine. I mean, if you want to be in the space of the banks, like nothing on here looks scary to me. Let me just take a look at the balance sheet and a couple other things. Now, it'll give me an opportunity. As always, this is not investment advice. Please, you guys need to do your own research when making any financial decisions and not listen to me. I am just a guy on YouTube and I do this for entertainment purposes and for fun. And really, I do. And partially, like, I know my wife doesn't want to hear me talk about the markets. I like to talk about it. I talk with my buddy Steve the most. He was making fun of me. He wanted me to do Coinbase as one of my top picks. And I kind of said, I actually, as a trade, think Bitcoin, MicroStrategies, Coinbase, like this might be a great area to be picking it up, but it's a really risky trade to put on. And I just, whatever. TLT. What is TLT? I've seen you talk about it and other things. I can pull it up, but balance sheet looks fine. I mean, the bank is just fine. Let me look at insider activity. That always has me curious. Have they done anything out of the ordinary? No, nothing. Just exercise of options. So nothing out of the ordinary and nothing super big. Like there's nothing that's glaring at me in Wells Fargo. My only hesitation are kind of the things that Joe says and my thought about just the ebb and flow of like popular or not popular, which is the banks seem to be pretty popular right now. And I don't like to be buying into something when it's super popular, but PE ratio seems fine, earnings look fine, dividends really safe. Like if I wanted to be in the bank space, there's no reason not to be with them. I used to look at, there's a smaller one, but they're going to be, let's see how they're looking. The Bank of Butterfield and Sons, because it's a small, like nobody knows of it. NTB is their ticker symbol. I like that it was a higher dividend, but let me take a look at their payout ratio and stuff to see. And they're, well, at least nobody's shorting it. That's good. Yeah, pays a 4% dividend using 33% of their cash flow to pay it out. That's what I like. Um, it's just a small bank nobody really knows about, but it's only got a 10 times earnings. Um, yeah, they're getting 20% return on equity, and they have a good profit margin. Like, I don't know. If I was getting in the bank space, I kind of like the Bank of Butterfield. NTB, I always thought of it as not the bank because that was what a buddy of mine was calling out. Um, but I don't see anything wrong with Wells Fargo, and if somebody's comfortable with it, the problem with the one that I'm giving is it's such a small bank. Like, it could move pretty far in either direction. So that's a good point about Bitcoin. Some of the Bitcoin derivatives have a higher percent upside on dead cow bats than actual Bitcoin does. Yeah, I don't know what I think. I like that nobody likes it yet in terms of Bitcoin. It's finally turning negative enough that nobody thinks it's going to do well. And I'm such a contrarian, no pun with my last name, that anything that everybody thinks is going to do badly, I'm like, start to get attracted to. And I feel like Bitcoin's gotten to the point that everybody hates it so much and they think it's just dead and not going to do well, that maybe it has a really good 2026 and actually hits those crazy numbers people were talking about. My problem with Bitcoin is I get it. I get both sides. Like, what the hell is it, and what do we really need it for? Even if we go digital, I mean, we are going to, I shouldn't say if, it's a matter of when. Do we really need a Bitcoin, or does it just become a historical, that thing was cool, and is it tulip bulbs that become worthless? Because what we really need are the stable coins. We need the digital dollars and the things that people can transact in. And unfortunately, I think the conspiracy theorist in me doesn't see good coming from that too, because the government controls all of it and knows, has a little bit too much power. I mean, God forbid you vote for the wrong political company or you say the wrong thing, you can be shut off. And look, I absolutely love China, for those of you who've heard it, but that stuff worries me over there. Like, if you're caught doing the wrong things, and I always agree with them of the things being wrong things, but they can really shut somebody off where you know their money's useless. No, they can't. So I hate to think of a world where big bad corporation or government can shut people down, but I do worry a little bit about that. But outside of that, I get the value of Bitcoin, but I also see that it has no value. But same with a Michael Jordan rookie card, like, or a Picasso. Like, why do people give such value to these things that really are a piece of paper, piece of cardboard, or just this program that was created that's pretty cool? Um, so I see both sides. It's a really interesting thing to watch in terms of a trade because it trends really well. It just gaps, so it's very dangerous, and I worry about advising Bitcoin to anybody. Um, but I also think if you do have Bitcoin, because I have a tiny bit, that there's value in uh, putting it on a thumb drive and putting it in a safe deposit box, and not like it, the whole point of it is having it offline and hidden, at least to me, and hidden in everything else. So I've always thought that the technology is cool. Like, when it first, I don't remember the price it popped up to, but the first time when I started paying attention to it, I don't know, maybe it was 2,000 bucks a coin or 1,200 when it first popped up, and then fell to 400 because somebody stole some. Some of the technology was really neat, and I just like playing around with it. You used to be, I'm sure you still can, you could print out on a piece of paper like your own version of currency. You could take a piece of paper, you could create a picture or whatever you wanted and a barcode, and you could put your own cash, whether it was Litecoin or Ethereum. I don't know if Ethereum did it. I know Litecoin did and some of the others, and same with Bitcoin. And somehow you could take it off being on the computer and put it on that piece of paper, and you could hand that piece of paper to somebody, and that piece of paper, like, that was money. So I think all that, like, the technology is super cool. Um, but I guess we'll see. Like, I don't know. I just think that that stuff's really neat. I saw years ago some guy who put a microchip in his hand, and somehow that microchip, like in a, sorry, I'm doing it, nobody can see. Like he had it put in his, literally a surgery. They took it out, put a microchip in, and somehow he could go places where they used it, and he could go like this and pay for stuff. Like, it's pretty neat. Um, but yes, I would agree with that comment from Joe that it is the most grossly overpriced asset on planet. Because that's why it's hard for me to advise on it. Like, it is a total nothing. But so is gold, so is silver, so is platinum. Which of the three, I really like platinum, because, you know, and this will show how bad I am too. So for those of you who watch me, like, really don't take my advice. So back in, I don't know, 1999, 2000, I bought a bunch of gold. It was $300 an ounce. It was so out of favor. I remember one of the traders telling me what a moron I was, and it was before I was more confident, and he was a good trader. So I thought he knew more, and I didn't hold as much as I should have, but I bought a bunch. It just seemed so out of favor, and gold is gold. Well, gold was trading 280, 290 an ounce, and, you know, platinum was bouncing around between 800 and 1200. Over the next however many years, eventually gold was up to like 1400 an ounce, and platinum was still bouncing around between 800 and 1200. And I'm like, this is the dumbest thing ever. And this is probably, I don't know, 2003, and I'm making it up, but it was a long time ago. So I sold a bunch of the gold and I bought a bunch of platinum. Well, shit, I think I was still down money up until a year ago, so 20 years. Now that platinum is finally moving, I still have this in my head that platinum should be more valuable than gold. Because what's so stupid to me is if you went to a jewelry store and looked at the same friggin' bracelet, one in gold, one in platinum, the platinum one is going to be significantly more expensive than the gold one. And nobody even questions that, considering up until the past 2 weeks, platinum was still $1,500 an ounce, while gold was 4,000 and change. So why would the bracelet be double the price of this thing that's a third of the price? And it still bewilders me. And platinum is still such a thinly traded market that as it's starting to go, I'm beginning to think, maybe it finally happens and becomes more valuable than gold again. But I'm worried that everybody's gotten a little bit too on the metal train, and Joe isn't so wrong that these things could have a massive correction. But forgive me, I mean, I was picking up silver when it was $4 or $5 an ounce, and just, it makes great gifts at the holidays. And now giving somebody one silver coin is a $75 gift. Uh, I, I don't know. Like, I'd rather give somebody a silver ounce coin or something than $100 bill. And it's not because I could care less about saving the $20. It's that I think it's cooler, and maybe they save it, and maybe it becomes a little bit more valuable. Whereas if I give them $100, they're gonna go spend it, and that's the end of that. Whereas if they have that silver coin, maybe they look at it and think of the idiot who gave them that coin. Um, Whatever, just my thoughts on it. Um, but let's see. I don't really have. I know somebody asked about XRP. I don't have a great opinion. Like, I'm not well in tune with crypto and which ones and whatever else, and what they accomplish. I think they're all amazing. I've listened to, the guy who created Ethereum, and he is so much smarter than me. It's like hard to imagine that these guys just don't change the world. It's just very hard for me to what it's going to look like and how they're going to change it. And if the net, I have the same problem with AI. Like, I don't think it's going to happen as fast as everybody thinks. And I don't know that there's more good than bad. And I'll dumb it down to, for myself and everybody. Like, I just think about autonomous driving. Let's say they get it to where it's totally safe. Well, I don't picture all of the Uber drivers being out of a job tomorrow. But what I do envision is whether it's Uber, Google, Amazon, or Tesla, that they're going to slowly introduce their driverless vehicles and people will start taking them. Maybe they'll be a little less expensive than using one that a human drives. So people start, leaning towards using those cars. And then some people aren't making the money they were making previously working on Uber. So they slowly siphon out. And I don't know what they do. And that continues to evolve where more and more cars get put on the road that are driverless and more people stop doing Uber. And I don't know what alternatives they fall into, and I worry about that with other professions as well. I do not see this massive over the next 3 years. We're just going to see this monstrous change. Like, things don't tend to happen that way, but I do think so. If you aren't aware, I do mortgages. Now, I never talk about it because please don't, like, this is not, I am not trying to use this as a platform to, like, if anything, I'm slowly doing less and less and trying to veer towards retiring. Um, but it's why I like real estate. Well, I got into it because I like real estate and math and whatever else. But the only, like, I've talked to my son, like, it's a natural progression. I've thought, geez, when he gets older, I can teach him what I do and he can make a living off of it, because you can do pretty well. But my concern is there is no reason for us at this point. There really isn't. And as AI moves along and the banks would want to save what they pay the employees, like, there's nothing that we do that the computer can't, unless you get into really difficult loans, which maybe they get to the point that they don't even care to do those loans. There's, Wells Fargo, for example, already has your credit information. Most people do direct deposits, so they know your income. If you have a car, they see the payments going out. Like, they can do an analysis just like we can to figure out somebody's debt to income and what they can afford and what they should qualify for. I envision a scenario where you don't even have to go through the application process. You'll get an email or a phone call saying, hey, are you interested in buying a home? Because we've noticed, you can afford one up to this price with this monthly payment on average if you've thought about buying. Like, and you won't have to hand in all your documents and you won't have to deal with all that headache. I even go one step further that I think, like, you'll be approved for what you're approved for, and then you'll be able to go look at homes. You won't really need a realtor. You'll just be able to, like, use a thumbprint or a face ID to let you into homes that you already can qualify for. Like, if you qualify for $500,000 and you want to go look at $1 million home and you go there, it just won't let you in. And by knowing your face ID or your thumbprint or whatever, it'll make you responsible for anything that happens in that home during the time frame that you go in to look at it. Now, let's say you use your face ID and you go look at that home you've been wanting to look at, and oh my God, I love that home. Everything's exactly how I want it. It's gotten advanced enough that I think when you walk out the door, if you say, hey, I really like this home, to some iPad in the door, it should be able to spit out to you the different options that you could do for down payment, what your payment would look like, whatever loan type you get. And if you'd like to hit the button, buy the home, it works just like buying a Tesla. You fill it out on some paperwork and you can probably close in a couple of days. Like, I just envision over the next 20 years, it totally transforming where you don't need the loan officer the same way. You don't need the realtor the same way. I think realtor.com missed a huge opportunity. And by partnering with the what's it called, the Realtor Association, and trying to get in with that, instead of, like, I think they could have stolen the whole business and really gotten to the point where we don't need the MLS, you guys need us, because I think most people go online to realtor.com and nobody really cares about the MLS. Like I think it could totally transform, and I guess we'll see. So let's see. Joe's made a couple of comments. Let's see if we've got some questions or things to talk about. VIX is setting up for a mini rally here. It could. I mean, the VIX has a tendency to stay low for a long time. Like, I don't know. I know that that means there's. Oh, I think that fixed it. It looks like I came back. Sorry about that. Um, Sorry, I use my phone to do this stuff, and it kind of sometimes if I get a call, and I tell people not to call during, but either way. Um, I know I was talking about the housing, but I kind of, oh, let me read Joe's because I think, oh, the VIX, like, I know it's greed when it gets low, but I've seen it sit low for months on end. So uh, yes, it will spike at some point. I'm not saying I disagree. I'm just saying don't be surprised if it stays low longer than you expect. Um, Seems like a serious unmet need. What's an unmet need? What am I? What's my need that's unmet? Um, so I know we were there. The VIX is sitting up upside target for Tess. What is Tessie? Is that the opposite Tesla bet? I mean, I think Tesla is one of the most overvalued stocks there is out there. Great company. I mean, I love the car. I just think that they're super overvalued. Oh, do you know any startups that verify content as no, and it is total. You are correct. I think it's a huge. I think there should have to be something that lets people know what's AI and what is it. I mean, some of it's obvious, right? We all like we see the dogs that talk or the cats that really look human and have those really cute videos, but or the people that save the bears. Like, how stupid is it that they're allowed to post those videos and what like some moron is gonna go talk to a bear thinking that that's a smart thing to do because they saw some stupid short on Facebook or whatever they're looking at. You're eaten by the bear, right? I think some of this stuff is such a bad idea. Um, but I think there should be something that has to delineate whether it's an AI or a real person. But I don't think there's anything out there yet. Look, even YouTube, like you guys know, I'm on here because I like the platform. But all the people talking about finance, I'll include me in that list. Like, I don't want to separate or like, oh, I'm better or whatever else. There should be some requirement, just like a journalist or anything else, where you can't just put on whatever you feel like that's total nonsense. I mean, especially if you've built up a following, there's nothing stopping a Graham Stephan from using it for negative purposes to go on. I mean, he's got millions of followers. Why doesn't he just buy a thinly traded stock and go on there and be like, oh my God, stock XYZ is the greatest ever. Look at their earnings, look at this, look at that. And then as his followers start to get in on it, get out of it. And even like the guys who go on with their there should have to be some accountability to how they do in the markets or something to be able to just go on a platform and do. Um, I like to think I give the best advice I could give, but I recognize like I may be wrong. I think that's what hurts the channel. I think some of these people. I watch some girl. She goes on and talks about how she makes 100% annually, and just sign up for my $5,000 consultation, and then we have my classes and whatever else. It's like it's like so ridiculous. Come on, you make 100% per year. Now, maybe she's a phenomenal trader, but she should have to kind of back it up. And if she is, great for her. But being a phenomenal trader is not a transferable thing you can teach somebody else with a strategy, as they say. Um, there is no magic pill out there that just it doesn't work like that. And I used to watch and I commented for a little while, because it drives me nuts when I think people are full of it. Um, and here, like, I'm sure she's just selling her courses and people are signing up. And if you get 100 people to sign up, yeah, 10 of them are going to have success. So you'll be able to say, oh, look at these people who are so successful following what I taught them. Like, it's just such a scam and so awful. I know that people are having to say, like, I've seen Ryan Williams and Ari Gutman and Russ from Dapper Dividends getting much more cautious about putting up a disclaimer and making sure that they say it's not investment advice and things of that nature. And I think some people did get in trouble for it. So I'm guessing they're cracking down a little. But my God, there was that guy, like, he was super entertaining and his channel did really well. I think his name was Todd, but he constantly was touting the yield max funds. And I'm sorry, I've watched a few people that are finally admitting how bad they've done with them. Some people do great, but I think they're trading it. I don't think the ones who have done great are buying and holding these yield max funds. For those of you who are not familiar with them, they essentially promise 80 or 100% dividends, or their distributions, not dividends. And I've listened to the CEO talk, and to me, it's like an old fashioned used car salesman selling you on double talk. So he talks about how, and this is the stuff that drives, forgive my rant, but this is the stuff that really drives me nuts about it, is he's selling it to retirees. Because if you haven't saved enough and you need a little bit more income and you can't live off of traditional 3% yields, we have these options that, pay 70 or 80% that you can invest in. That sounds great. And then they talk about the NAV erosion, and he goes, well, really, to do the best you can, you should reinvest those dividends. Well, wait a second. I thought it was meant for people who hadn't saved enough and needed those dividends because they needed a higher amount of money to be able to live on. And you're following up with it to say, but they have to reinvest those dividends, otherwise it's going to slowly drop to zero. So which is it? Are they getting a better return where they can live off of those dividends or distributions, forgive me? Or do they have to reinvest them in order to not lose all their money? And the reality is, as a trader, I know it's number two. Covered call strategies are going to underperform. And then if you go with a super aggressive one that is hyper focused on an individual stock, selling calls that are only 5% of the out of the money so that you're limiting your upside on your potential profits, you're crushing your potential profits while still taking on the whole downside risk. On top of that, if you look into those funds, not only do they do that, they don't even buy the stock. What they do is they get synthetically long, meaning they buy the call and they sell the put. So if you have a stock trading at $100, you buy in $100 call, you sell in $100 put. Why do you do that? Well, you're long the stock because if it goes up, you exercise your call. If it goes down, the person who sold the call to you or bought the put from you, they're going to exercise it. You're long the stock either way. Well, you do that because you've worked an agreement with the company that you're clearing through that you don't have to put up the money. So if you buy in $100 stock, each $100 shares or each lot of 100 shares is $10,000. If you do it synthetically with options, maybe you work an agreement where you only have to come up with 25% of the money so you can be leveraged on top of it. And that's the only way you might perform okay because you're doing 4-to-1 on these trades. Forgive my rant, but I used to trade at the exchange, so I understand a lot of how some of this stuff works. And now you're selling it to retirees. You are taking something that you are doing 4-to-1 leveraged, just a guess. I haven't looked into it deeply, but they're doing high leverage to promise a return that is highly unlikely to really be a return because you're using some of the money that's been deposited to pay out in your distribution. And I get it if somebody understands the risk that they're taking on. I don't get it if you're selling it to retirees and people who trust that you have a fund, that you know what you're doing and you're looking out for their best interests. And I see the same thing with some of the YouTubers. My rant is like, I don't care. Like, if I don't do well, it doesn't change anything. So I don't have to sell anybody anything. So either way, just my yapping and ranting about the yield max and stuff. I see it kind of got everybody silent, so so I'll stop ranting about it. But I hate that stuff. I think JEP-E and JEP-Q are probably just fine. They're super conservative. But unfortunately, there is no magic pill that just automatically beats the market. And even the research that I do that makes me feel more comfortable about the things I buy, the market is efficient enough that it's hard to believe you really find that needle in the haystack that outperforms. Like, I've been watching since I was a kid, so I like to think things, markets are markets, and something like, you know, I used to watch Sara Lee talk about the most boring company in the world. Well, it would trend over like a 10-year period and it would fall in half and then it would slow. So when I look at something like Conagra, I'd like to think you're getting a really nice dividend because it's just been out of favor and nobody pays attention or cares about Conagra. And maybe over the next 5 or 10 years, it drifts back up and continues to pay that dividend. But I don't think there's any real advantage to what most people have. I even did a video, somebody essentially, I don't want to say called me an idiot, but called me an idiot because I have too many tickers in my portfolio, and they think you should be hyper focused the same way that Bill Ackman does. Which, look, Billy is a smart guy. He's done well for himself, but he grew up in the same town, and I actually anyway. But Billy has access to CEOs and information that you and I just don't. So if we're going off of the information that we have and we don't have access to things that these guys have, to hyper focus on individual stocks and think that you're going to just crush it because you have a high conviction in Meta or the five that I picked, there's just things that might catch you off guard. And I don't think diversifying makes you an idiot. I think it protects you against yourself and protects you against the things that we don't know. So again, the basics is save, put away, diversify, continue to save, and then hope when you get older you've got enough that supports your life. Anyway, thanks for everybody who showed up. Any last comments, feel free to put them in. I really appreciate you guys coming here. I love the live platform. I wish I was a little bit more popular on YouTube because I'd like a little bit more interaction, but it is what it is. And I really do just do it to kind of get out what I feel like talking about. Joe, I think you should have your own channel. Like, I know you said once, like, if it bothers me, it doesn't bother me. A lot of times I don't respond appropriately because you talk about tickers I'm not familiar with and think like straightforward. I just don't know some of the things that you're looking at and how they move. And if I don't watch something religiously, I don't want to make a total guess on it. I can pull up financials and look at a chart, but I know you like to play